mic on. I could hear me. Somewhere in there, I think it's on, let's see if I can pull it up real quick. David Durant is listed as being a seconder on a motion made by Tom Butt. And I don't think it was David Durant. I think it was somebody else. Because I don't think he was here. So, yeah. It's item 11. No, it was item 11. It was, yeah, the Hercules Rail Station. Tom Butt made the motion and somebody else seconded the motion for the Hercules Rail Station.
And that's in July?
Mm-hmm.
Very good.
That's why I couldn't remember. But I knew David Durant wasn't here. So, just for the record. Okay, so we have a motion and a, yes.
I guarantee it wasn't me here. I became a
I think it might have been Mike
grandparent
Metcalf.
that day twice.
I think it might have been Mike Metcalf. That would be my guess.
If I didn't second, I would.
You would have. Anyway, we just need to clarify that. Okay? So with that, we have a motion and a second. All in favor say aye. Aye. Opposed? That carries unanimously. Thank you very much. And we will go on to the consent calendar. Are there any items anyone wishes to pull for separate discussion? If not, do we have a motion?
So moved.
Second.
Have a motion by Budd, a second by Taylor. All in favor say aye. Aye. Opposed? That carries unanimously as well. All right. We are on to item 14, which is an RFQ for investment banking services and an update on the authority debt portfolio. And Randy, you're going to handle this one?
I am. Thank you. APC Chair Pierce, members of the APC and staff. My name is Randy Carlton. I'm the CFO for the authority. We have before you an item in part information, in part action. The information is to provide you with an update on our debt portfolio, talk about our future plans, and then the action item is to request your recommendation to the board for staff to issue a request for qualifications to form an investment banking pool to assist us with our future bond offerings. There are about a dozen slides today. They're all aimed at trying to address the more significant points that are addressed in the staff report. We'll do our best to not be redundant with what the information that you've already received. And starting with where we are, starting with our history at first, you could see on this one slide what we've done since the inception of Measure J. And as you know, Measure J started in 2009. That's when we first started receiving our sales tax revenue. But shortly after the approval of Measure J in 2004, the board, working with its financial advisor and then CFO at the time, began thinking about ideas on how we can accelerate project delivery, how we could eliminate risk, improve our certainty for the future and our planning of the strategic plan. What came from that was this product called the swap, the interest rate swap, which was entered into in 2005. It did nothing for 4 years. It sat there and intentionally had a delayed start date of 4 years. It began in 2009, and I'll get to some of those details in a moment. But in 2007, we put together a commercial paper program. That's a form of short-term borrowing. We received a credit line for up to $85 million. We drew down $69 million. We put some of that money directly to work on State Route 4. In 2009, when the swap was to begin, we came into some money from the federal government through ARA and assistance with the Caldecott Tunnel. That money came in and backfilled state obligation. We were able to downsize our swap, our bond issue. So we took it from $300 million to $200 million. We paid off $100 million of the swap at a cost of $11.4 million, and we raised $122 million of additional capital on top of what we've already borrowed through the commercial paper program to start funding Measure J projects. 2009, as you know, was also a tough year. We're on the heels of the the housing crisis, and the market was very unstable. The cost of liquidity was very high. You may recall we had a couple of workshops and several discussions about our options for how we're going to go about issuing bonds. And the consensus then was to let's just bridge over this tumultuous period of time, wait for the market to return to normal, wait for liquidity rates to come back to a level that made more sense from a business standpoint. And what we did was we issued those one-year notes in 2009, and it was very successful in terms of meeting our objective of bridging that financial crisis. In 2010, those short-term notes became due, and we did a very unique transaction at the time. It somewhat was a trendsetter. It has become something, in fact, that I spoke to one of our finance officer conferences about because it was such a unique type of product that was coming forward at the time. But it was a private placement floating rate note instrument that we were able to put together with the assistance of RBC Capital Bank as the investor to where we issued these notes without any credit enhancement, without the additional cost of credit enhancement. So we did this on our own credit, and we saved a lot of money by doing so. The purpose of those 2010 floating rate notes was to take out those one-year short-term notes that we issued in 2009, and it also ties in with our swap, which I'll address in a minute. Where we stand today, we have a very strong bond credit rating of AA+ with a stable outlook. That, by the way, was just reaffirmed earlier this week by Fitch Rating Services. You may have seen the press release that came out. They affirmed our AA stable outlook status. We have two series of bonds that are outstanding, the 2012 Series A bonds. Those are a floating rate type instrument. They're integrated with the 2009 swap. They are floating rate, very similar to what you would compare to an adjustable rate mortgage for home financing. The purpose of those bonds were to take out the 2010 bonds in the form of a long-term type borrowing. There are a couple of triggers here that we need to be aware of, and in part what's laying the ground for our recommended action today as we talk about our future plans, and that is these mandatory redemption date and an optional redemption date. We have to take these bonds out no later than December 15th, but we can do so earlier on June 2015, and that's something that we're looking at now. The 2012 series bonds, those are your more conventional municipal type bond. It's a fixed rate bond. The all-in borrowing cost is 2.11%, historical low point in the market. It raised over $225 million for the Measure J program, and we built this one we structured this one with a unique call feature where it was call protected for 7 years and becomes callable in 2020. And by doing so, we received a very good pricing at the time when we issued those bonds. That 2.11%, again, was a historical low point. This is looking at our outstanding bonds in a graphic sense. The bonds are out there for the entire length of the measure till 2034. There's two lines here. The black line represents our revenue forecast of sales tax between now and the end of the measure. But the red line represents approximately 40% of all of our revenues, and that is our self-imposed maximum debt that we as an agency have placed on ourselves. That's equivalent to the 40% amount of 40% amount of our sales tax we've earmarked for projects, and the other 60% to programs. So what we've done here is we've said we're going to only issue bonds up to the amount where we're leveraging 40% and no more. And you can see that there's some white space there between those two slices that represent the 2012 A bonds and the B bonds and that red line, and that's our future capacity. This is an interesting line chart. I just would like to take a moment here. Now, no one has a crystal ball, but I would think that Iwasaki maybe does, because we've been calling interest rates right all along. And prior, in the early years in 2005, when we approved the swap, we locked in our future borrowing costs that would start in 2009. That future borrowing cost was 3.66%. You could see that we were in about a 4% market at that time in 2005. So we were already beginning, slightly below the market. We were taking a little bit of risk, okay, with that swap and speculating somewhat on interest rates. But, if we were all sitting around the table in 2005 talking about, well, would we be satisfied with a borrowing in 2009 and it would cost us 3.67%, not knowing at all what the future holds, I think everybody would say that's a pretty good rate. Let's go with it. Well, you could see in 2009, again, this is a bit skewed because of the financial crisis, but look where is this monitor on down here, by the way? Okay. You could see where in 2009 where the market was. This blue line is what it's tracking is municipal interest rates from 2004 to the current day, and you can see how interest rates spiked in 2009. Well, if we did not do the swap, okay, if we did not do the swap in 2005 and we just waited to do bonds in 2009, look what kind of market we would have been in. All right, and instead we said, well, we don't want to issue long-term bonds in this kind of market. Let's issue those short-term bonds, those one-year notes I talked about earlier. Well, we did that, and look, if you could just draw a line from 2010 up, look where the market is, below 4%. So, we hit the market perfectly in 2010, and making that choice to just issue those one-year's notes really proves to be a very cost-effective decision for the authority. From 2010 out to end of 2012, beginning of 2013, that's when we issued the 2012 bonds. That was in December. Look, interest rates were at a historical low point. We issued long-term fixed-rate bonds at the optimal point in time in the market over a 20-year period. All right, the swap, and I promise not to get too deep in the weeds on this one. I do think it's important for us to have a general understanding. It's a unique type of product. Not every agency will have one. They're very common in transportation type authorities, but I can appreciate that they're just not part of your brick and mortar as a municipality. But I do want to take a few minutes and talk about it. When I say swap, it's a contract. It's a contract between two parties. The two parties, CCTA and Bank of America. And we both agreed to trade streams of cash flow based upon a predetermined set of terms. We entered into it in 2005. We amended it in 2009, reducing it to 100, or reducing it by 100 million to a total of 200 million. I'll say this now, and as we get into some of the numbers, you'll see this. But we could say with all confidence that the swap is performing. It's doing exactly what we wanted it to do, which is hedging our risk against future interest rate risk. Here's a picture, and if I'm going too fast through any of this, please stop me. The first part, you see our logo there and Bank of America. There's some straight lines and some squiggly lines. The straight line represents what we've agreed to in that contract to pay Bank of America 3.66%. That squiggly line below it is what Bank of America has agreed to pay us based upon a floating rate index. That floating rate index in this case is a LIBOR index, and that's less than 0.5% right now. So you may be wondering, well, the amount that we're paying this on is $200 million. What sense? How does this make sense? We're paying Bank of America, 3.66% on $200 million, and all we get in exchange is a stream of cash flow that's based on something that's less than 1%. Well, there's more to it. The upshot here is that Bank of America has to pay us whatever the interest rates happen to be between now and 2034. We have no idea what interest rates are going to be. They have no idea what interest rates are going to be. But no matter what they are, they're under contract to pay us. What that does for us is that mitigates our risk. We have risk on interest rates as well, and that's where the other squiggly line that goes below CCTA is, we have our bondholders out there, and those bondholders of the 2012 A bonds are receiving interest based upon a floating rate index, and that happens to be the same type of index, which is LIBOR. So what we're receiving from Bank of America and what we're paying to the bondholders offset each other. They match. They're actually slightly to the betterment of the authority. So all we're left with is that 3.66% cash flow that we're obligated to pay Bank of America. Again, 3.66% in this market, we'll take it. That's a very low cost-effective rate. A little detail here, but to roll up the numbers of what the swap is costing, you could see that, or the swap and the bond transaction in total, you could see that we're paying the 3.66%. We're paying the 0.104% and a fixed spread on top of the bonds, plus, or I should say, less the amount that we're receiving from Bank of America represents an all-in net borrowing cost of 3.743%. The table below is, I mentioned earlier that we were doing slightly better. You could see in column A, that represents what we're receiving from Bank of America. Column B is what we're paying to the bondholders, which is an amount slightly less. You take the difference, convert it into dollars. That's about $47,000 a month to the benefit of the authority that we're receiving off the swap. The swap does have, and this is where some of the controversy comes into play. It does have a market value. It is a financial product that has a market value that changes daily according to where interest rates are. It has a current value of yesterday of a negative $42.3 million. As interest rates go down, the value of the swap goes down. As interest rates go up, the value of the swap goes up. Anytime that the value is south of $40 million, we're obligated under that contract to cover that exposure with Bank of America with collateral. So what we do is we take securities out of our investment portfolio, U.S. Treasuries, and we have to transfer them over to Bank of America, and they hold them until the interest rate market changes, and at that time I call them back in. However, during the time that Bank of America is holding them, we continue to receive the interest just as if they were in our portfolio. You can see the history of the value of the swap, as high as a negative $53 million in 2013. It's going to fluctuate. It's going to do this probably throughout the life of the swap. This is strictly a paper type of value. It's only a loss if we choose to terminate the swap. If we chose to terminate the swap, the cost would be, $44 million.
Excuse me, Randy, Mike has a question.
Yeah, before it becomes not timely, you just mentioned that the collateral. Okay, so the collateral goes to B of A. Now, it's earning money for over there at B of A, just like if we're earning money over here. an interest income.
Yeah,
So who gets the interest income?
well, there's two sides to the swap transaction. There's, our side, and then there's, the other party.
I'm talking about the collateral.
The collateral. Well, the collateral is being held by Bank of America in a separate trust.
And who's getting that trust income?
And who what?
Who gets the income from that trust?
The authority does.
Okay.
The interest on those securities continues to come to the authority just as if we were holding it.
So, if someone said, well, are we losing money on that collateralization? The answer is no.
That's right.
We're not.
None
We're
whatsoever.
getting income from it just like if it was over in our accounts.
Right.
Okay.
All right. The only
It's
thing
just not liquid.
Yeah, the only thing and that's the point of it, is just the liquidity is, we don't have it at our disposal to do active trading with those securities, but we have another 60 million of Treasury securities in our portfolio for that purpose. Now we're looking at our bond capacity, what we could afford. This isn't necessarily what we're going to issue in the future. That decision will be made closer to the time when we need to raise the bonds based upon our project needs at the time. But if we wanted to just ask the question how much we can afford, we take a look at our sales tax projections, we take a look at our debt, and we come up with an affordability. This is what we're looking at, about $100 million we could raise in 2015, somewhere around the July timeframe. And looking a little further out, in 2020, we could raise another $105 million. So we have, roughly $205 million that we're going to be raising between now and 2020.
Hey, Randy, can you illustrate the prior capacity before the last bond sale based on the interest rates? So we went from a future secondary bond sale of 61 million to now to 200 million, right? And that's the power of getting the right interest rates.
Yeah, there are a few things that went into what Mr. Iwasaki is talking about. You may recall that we revised the 2013 strategic plan. We did so at the time when, shortly after we issued the 2012 bonds. The 2012 bonds at the low borrowing costs that we received of 2.11%. The fact that we improved our revenue forecast, all those factors went into increasing our capacity, and we were looking at only issuing $68 million more, and now that's gone from 68 million to $205 million more. Again, this is asking the question, well, if we wanted to max out the credit card, how much could we spend? How much we actually spend will be something that we address closer to the time when we need the money. This chart here you've seen earlier, but what we've done is we've added the future debt. You can see that we're right up against that red line of what the 40% of our revenues represents. There's this particular indicator that's used in the bond market. It's called maximum annual debt service, MADS, as one indicator. Something north of 2 times, meaning we have 2 times revenues for the amount of debt that we have outstanding, is considered a very, very strong coverage. So we are in a fortunate position where we can pledge 100% of our revenues all the way up to that black line, but from a business standpoint, we're only limiting ourselves to 40%. But we get the benefit from a credit standpoint of pledging all 100% of our revenues. And that's what gives us such a good bond rating. That concludes the informational part of the presentation. I would like to move on to the action item, but if there's any questions about our debt, I'd like to
Mike?
address those now.
Yeah, before you move on, if you go back to that previous slide, does that suggest that, we're by policy restricting ourselves to 40% of our revenues for debt? Okay. Does this suggest that if we took a more aggressive stance that we actually could go take on more debt and maybe do more than we are currently programming? Increase our leveraging? Is that what it's saying?
We could issue more debt. There are trade-offs, of course. One thing that we value is our high bond credit rating of a AA plus, and there is a potential that could even go better to the AAA category. So there's always those kind of trade-offs. If we want to take more risk and borrow more, we can do that type of we can put together that type of a strategy. But in all likelihood, that would mean higher risk and lower bond ratings. So that potential exists. Again, we're looking at already the maximum amount of $205 million, and still keeping really strong coverage levels. But if we wanted to issue more, that would be a business decision that we could talk about at the time.
Well, I'm not personally, I don't have a position on this yet, but I'm wondering if the planning committee would entertain the thought of maybe trying to be a little bit more aggressive, and if there are things that they would want to do that really ought to be done. Should we be reconsidering our earlier business decision at the 40% limitation? I'm not saying we should do it. I'm saying should we at least consider it? Because if we have, yes, of course it would put us on a lower credit rating, but we're at a pretty lofty credit rating as it is. You're just as high as Moraga now, I'm happy to say. Anyway, if we could maybe get a little bit more out on the limit, we could do a little bit more. Is that something that's worth considering?
I would respond that that's probably a good discussion to have as a philosophical policy discussion. As I recall, one of the reasons we set that 40% threshold was because that's our percentage of projects, and the rest of it is pay-as-you-go for programs, and we wanted to make sure we had the program money available. So that was kind of the philosophy at the time, but we'd have to look at how we would manage to still manage the programs if we were to leverage ourselves further. But that might be a good discussion to have at a point where we can do that without the pressure of having to immediately do something. So, Dave?
Yeah, I'd recommend that we take it to the chair of the planning committee so that at least we let the other members know that it's something coming up for discussion. We're really setting it up for a full board.
Mm-hmm.
You commissioners, another way to look at this is, because we've kind of taken a look at this as maybe a windfall, if you will, and we had talked about the if we went out on our 5-for-1 deal and we got $44 million of CMIA Part 1B money, put it on State Route 4, pulled $44 million of Measure J money off. Historically, what we've done is it's gone back to certain categories. And we convinced at the time Chair Tatson that it would be discretionary. So really another way to look at this would be is if you went from 61 to 200 and you've got 140 million of dollars, future dollars to invest, historically what we've done is we've modified the strategic plan to raise the caps in certain categories. You don't necessarily have to do that. And that would be another way of approaching it where you're not going above the 40, but you're giving yourself more flexibility because you have more dollars because that interest rate was so low at the time. So that's another option if you think about it versus trying to, the beauty of that 40%, if you do the math, we have 2.5 cover, and that's why we get such a great bond rating. You get your interest rates or your costs are lower, and that's why we like that. We want to be actually AAA if we can. But that's another option is it's historically you've always raised or lowered the caps. And so the staff doesn't have any flexibility to do those things that or neither do you, to do those things that you're talking about. That may be another opportunity or another strategy to deal with what you're asking for.
Randy, go ahead.
Okay, great. Thank you. All right, moving on to the action item. Staff is requesting approval to issue a request for qualification for investment bankers, otherwise known as underwriters. They are the the banking firms that we work with on a negotiated sale to structure the transaction, to market the transaction, and to actually be the purchaser of the bonds on the day of pricing. We look at them as like the wholesaler. They buy the bonds at a wholesale rate and turn around and sell them at a retail rate to the investors of the world. We've done this before in 2009, where we pre-qualified 7 banking firms. We've used just about all of the firms from that pool over the years. It's time to revisit it's time to revisit the banking firms. There's been several consolidations in the banking industry. Some have more of a presence in the municipal markets than others. It's just there have been a lot of changes over the past 5 years. The scope of work I've touched on, but it's pretty much is the marketing of the bonds and the purchase of the bonds. Some of our next steps, we always look at our debt and looking for opportunities to refinance our bonds at lower cost. We have taken a look at the 2012 B bonds. Those are the fixed rate bonds, and although there is some savings that are available in the current market, we think it's more cost effective to wait towards that call date that I talked about earlier in 2020, where we could have a substantial amount of savings compared to what the amount that we could capture today. We want to keep doing what we're doing to maintain our high bond credit rating. We had a conference call earlier this week with Fitch that involved Randy, Ross, and staff to address their questions so that they could reaffirm our strong rating. We have current information on our website for our bondholders so that they know how we're doing financially. And all those things go into this very important part of managing debt, and that is investor relations. Once we get the RFQ out there, we will come back to you with a recommendation for the new banking pool. We'll look to put together a transaction to take out those 2012 Series A bonds that have a mandatory tender date of December 15th, and we'll put together a plan for the 2015 transaction. So, I'll just conclude with the staff recommendation is that the APC recommend that we issue a request for qualifications for investment banking firms.
Dave?
Yeah, if I can, to start off quick, first on the issue Mike brought up, I think it's good to get it before the planning committee as informational only, simply because your counterpart usually chimes in on that, and we're getting to the end of the chair's term, who's also on planning. If he wants to address it during his, fine. If not, he'll find somebody to dump it on. The second is to get into the meat of this. I'm fine with the RFQ. I'm reading this as first the A bonds, and I think you've got it, redeem or refund. I'm fine with the direction I hear you going. The second financing, I'm sure you meant July 2019 or 2020, not 2010. But I'm looking at timeliness. Again, timeliness for exactly what Randy just said, the power of bonds in a timely manner. We're at 2015, so we can pretty much address that. Let's do in 2015. And I like where I think you're going on this. The third one that's got my attention is I'm not sure where the call for B, it talks about 2019 July. Am I reading that right? Or 2010? Is it March 2010? Anytime in 2010? And I don't need the answer right now. The direction I'm looking, is there anything we could do ahead of time, which relates to what Mike was talking about, that 40% level, that would allow us to take tremendous advantage of these extremely low rates? I was in real estate a long time. I remember 20%. I don't want to lose it. When it jumps very, very fast. So what we may be discussing, and I don't know if it's this morning, Okay, where is your risk tolerance? Where is your risk tolerance? I'm fine with the RFQ, but I think over the next several months, we may be addressing that more than anything else. Because you're talking 2019, 2020, you could be back at 19 or 20%. It happens quick. My feeling is that we've guessed right. I don't know if the odds are now against you to not guess right, but I like what we've done so far, and I like the projects that are out there, which I think relates to what Mike's saying. And I think it is timely to start thinking about that third one more than the refinancing. Risk tolerance. Do we want to go a little higher?
Okay, Mike?
Yeah, just building on what Dave said, which was building on what I said, so let me build further on that. I think, there are some members of the authority who understandably, have an adversity to risk. I tend to look at this as, if you've got, it seems to me we're leaving something on the table here. We've got capacity, we've got bonding capacity that we're not using, and the reason we're probably not using is because we're scared to. And I know you're not, but you're an engineer like I am, but you don't get, I think the public expects two things. One is they expect us to do things, and they want them, if there are things to be done, do them, find a way to do them. The other thing they expect is to not spend money foolishly. Don't do stupid things. So you want to do the right things, but you want to do it right. And I think we have a pretty good track record of doing just that. So what I would like to suggest is that we not just put this out there as to the planning committee saying, well, gee, wouldn't it be nice do you think you'd like to do some more things? You'd be a little bit more aggressive, but point out to them just how much more aggressive we could be without being foolish. And let's have that conversation. I think the public would appreciate that.
If I may, a point of clarification, it wasn't so much whether or not planning committee makes that decision. It's who's on the planning committee and whether or not they want to take it up sooner than later because he's the chair for a couple more months, and to introduce it. There is discussion about, that's a big line, and you'll find the adverse to risk quotient real quick.
I think you've heard the indication from us that we think it's an authority-wide discussion, and we need to at least revisit those policy decisions that were made a long time ago.
And thank you.
Pardon?
Just as a matter of completeness here, can we hear from our colleagues who said nothing so far on?
Free cell, sleep. Sorry, Tom.
Any comments from either Bob or Tom?
I don't see, it seems pretty routine to me.
I figured you're not saying anything, you must agree.
Exactly.
Okay, that works for me.
Well, since I'm one of the seven dwarfs, which would I go, was it Sleepy and Dopey? I guess the curiosity I have, they keep talking about interest rates are going to go up. Okay, when interest rates go up, what do bonds do?
The cost goes up.
Right. So the talk, but then the other talk is not for quite a while yet. So, and I would say it's definitely worth looking into if we can, as my fellow colleagues say. Of course, I play blackjack and roulette, so I'm all right with it.
Okay, I think you have direction to bring this back for a policy discussion. I think that's a really good idea. And what we need is action on the RFQ. Motion by Hudson, second by Metcalf. All in favor say aye. Aye. Opposed? Yes. All right, I'm sorry. Discussion?
Discussion.
Yes, Mr. Taylor.
Just for clarity, if we proceed in this direction, how does that affect the decision of what we're asking for more info on?
It doesn't. Not at all.
Not at all.
Not at all. This would pre-qualify a group of banking firms, and we can use them or not.
And Chair, ABC, if I could, for just a moment, and introduce some of the banking team that has been very helpful with us from the past 2005 pool. We have Bob Williams from RBC Capital. His firm was the purchaser of the 2010 bonds and also the lead underwriter for the 2012 B bonds. The 2012 A bonds. Peter Schellenberger to his right is our financial advisor. That's everyone. Right.
Wonderful. Thank you all for coming. We look forward to a healthy discussion, and I'm sure you will be helpful in helping us guide that discussion. So, yeah, Mike?
Yeah, I made a comment to Randy privately before the meeting, but I think this report, the staff report, is just right on the mark. It's just well-written, it's clear, and I think everybody here understands it quite well. But there's a lot of people that don't understand the swap, don't understand how we're doing the financing. I think you've gone a long way to helping it out. You might want to consider, before this comes to the authority, would it be worth including some of the material that you provided, which talks about the interest rate history and the time we put the swap in place? This is more background information. It might be useful to put that in.
Or just put the graphics in for
Just the graphics,
reference
right.
along with the current discussion. I think the graphics are helpful.
Yeah, because it would just make a very good story even better. Well done, thank you.
Good job. And yay for us and all of our wonderful financial team for helping us keep that AA plus rating. That's pretty awesome. So, all right. So we have, as I said, it was a motion by Dave, a second by Mike, and we had a unanimous vote on that. So on to item 15. That's the revision to Chapter 4 of the Admin Code regarding conflict of interest.
Yeah, I'll be bringing this item forward as well, APC Chair Pierce. All right, shifting gears. This is a revision to our administrative code, in particular our conflict of interest code. General Counsel has taken a look at our code. We're required to do so by state law every 2 years. So they have taken a fresh look at it and have come back with some recommendations. A big part of what this does is, instead of using our code to try and parrot everything that's in state law that's subject to change, what we're doing differently now is adopting by reference state law on this matter, so that as state law changes, we will be in conformance, or we will be able to implement those changes and be in conformance. There are a couple other things to it. In looking at our staff positions, looking at the committees that support the board, and some determinations that have been made where there are additional staff members that will begin to report on Form 700 in the same fashion that many of us do already. And then with some of the committees, you'll see on page 15.5 the committees listed that would be brought into the fold of Form 700 reporting. Some of these members, there's about 160 of them when we take into account the alternates. Some of these, I couldn't tell you how many, but there is going to be a part of them that are already doing this anyway. And so the additional requirement will be to do the assuming office type of filing, and then every year thereafter, just including CCTA, along with the other agencies that they're required to report on behalf. The recommendation is based upon what we're being advised by General Counsel to make these comments, and I'm happy to allow Chris to make a few comments as well.
Thank you, Randy. I would just add that really what you're looking at here is additions of committee and commission members solely because we've looked at their job descriptions essentially, and it looks as if, in our opinion, they are participating in governmental decisions. If you also look at historically how they've operated and given recommendations to the board, again, we see them participating in governmental decisions. And so at the end of the day, conflict of interest codes and the FPPC want to kind of stamp out any kind of decisions that are made on kind of personal financial interest. And so in our opinion, it is time to bring those committee and commission members into the fold, have them report in terms of Form 700 compliance, and then essentially that would guide their decisions, and we would be able to look at how their decisions are playing out in terms of those financial interests. And really, this is, in our opinion, the safest and most conservative approach for the CCTA to take at this point. So if there's any questions, I'm more than happy to answer them.
Tom?
I'm looking for strikeouts and underlines to show the proposed changes. Am I missing something?
I can address that, Commissioner, but it was such a lift out and drop in of language that it just wasn't practical to do a strikeout. Like I said, on our existing code we made an effort to restate state law at the time when our code was written, and state law has changed so much. We've really condensed it down to just a referencing state law code so that we're staying up to speed whenever state law changes. There won't be a strikeout version.
Right.
Okay.
Okay.
He's got them. I can't find them.
He
on my
did, they
page.
weren't on his. I'm
Okay.
seeing you
Dave?
look at me, I assume it's me. I'm really fine with this, and I would say it's overtime to do it. It seems like constantly on some kind of policy committee at my city level doing this. I don't see Section 1 or Section 2. Frankly, that doesn't bother me either. If there's a difference on how extensive the Form 700 has to be filled out, it would come back to APC. I'm ready to move 1401 if there's a second and further discussion.
Yeah, I'll second it, but I have a question, observation, whatever. In another county, Sonoma, back when there was a redevelopment agency in a place I was not intimately involved with it, but I'm aware of a situation where a lot of people wanted to be on the oversight committee of this redevelopment agency. And the list went from very large to very small when the people started to realize that they had to actually do a Form 700. Now, I'm not suggesting that the people that we're dealing with here are that same ilk, but it's worth asking ourselves. Okay, you've got how many would qualify for having to fill out 700? Hundreds of them?
160.
160.
Yeah.
Wow.
And I would bet that there are probably 20 at the most who already fill them out.
Yeah, and I'm wondering
Just
if
based on the number of electeds or planning commissioners.
Well, it's
that
not the
are already
electeds;
there.
it's the ones that the advisors, the ones that are picked up.
Well, I know,
appointed.
but there are some that are crossover. Yeah.
And I wonder if we're going to lose a lot of enthusiastic.
We may have some staff
participants.
people who, advise these boards that object as well. I don't know.
Commissioners?
And I would add, part of the process would be when this comes to the full authority board, to have an opportunity. We would notice those individuals so they have an opportunity to come and comment and raise any objections that they want. And that's part of the process of updating our code.
I would suggest that it probably needs to go to each of these boards as well. I think we take action here today to indicate our interest. I think the board does the same, but I think somehow we need to get kind of a touch with these folks to just see how big the outcry could be, because I agree with Mike. There are some folks who are going to object vehemently, that they are private citizens and all they're doing is advising. I understand that the language in here that is prompting this is that they make recommendations, and for the most part, we accept those recommendations relatively unchanged, and that's what makes them an active governmental body. But I don't think they get that. So they may be thinking, and I can understand how they might feel that by imposing this, what they would consider a burden on them, that we are trying to stop them from commenting freely by making them officials. So, I don't think it's that big a burden, but they need to understand what's involved.
It's perceived as an invasion of privacy,
It is.
and I can understand that, but, it's part of, if you want to participate in the governing process, you have to do these kinds of things. So a lot of people just don't understand that.
Okay, Dave and then Tom.
Classic example of what you're talking about. Peter Engel's not here, but we have the traffics program that we ran, and the director of that didn't want to fill out a 700, and we said, do it or don't be director. And that's the way it has to be. I'm sorry, but you're a public official. When you get on these, you have to follow the Brown Act, you have to follow the 700s. We just set up an open space oversight committee, of which we took out of city representatives. So now, and that's why I asked Section 1 or Section 2, Seth Adams will be filling out his Form 700 for San Ramon, and he doesn't live in San Ramon. But people have a right to know this stuff. That's all they know. And if we don't have them do it because we're a decision-making body, we're responsible for not disclosing to people things that they would want to know. That's what this 700 is about. And if you don't want to be on a lot of committees that have to do them, you'll find out real quick come January when you have to fill out about 18 of these things, and it's not that much fun.
And it's also not that hard. Tom?
Could I use this opportunity to ask staff to put on a future agenda item the ethics training requirement of CCTA? It's very weird. It's not like any other agency. And
Our ethics training is the AB 1234, just like everybody else, and we have to file our
it's
certificate.
different. It's not like any cities. It's not like BCDC.
Yeah, it's just
They've got
exactly
their
the
own
same
very
one.
they've got their own very weird, murky requirement. I think we need to take a look at it.
Okay, we'll take a look, Tom, but I'm almost certain because I filed a copy of the same certificate in both places.
Well, I did too, but they told me it wasn't right, and I had a lot of discussions with the AG's office, and the AG agreed that this agency had a murky policy, so.
Oh, okay, well, another assignment. Well, who knows, you know? Okay, thanks, Chris.
Madam Chair, just for, again, the learning process, when people get on these committees and everything, are they, who is it imperative upon to let people know that this is a part of the requirement? Does that come with the paperwork, or does that come when they get nominated, elected? Is it our responsibility? I'm using us as a very broad spectrum.
In general, I think once somebody gets appointed or selected to sit on one of these commissions or committees, at that point, I think authority staff would then let them know that there is a requirement to file a Form 700, assuming office.
Have we ever done that?
No, that's what
Not
we're-
for these
what we're
committees
doing
or
right now.
commissions. These
Well,
are new designations.
In
But-
addition, we're going to have to schedule some 1234 training, some Brown Act training, all of that, and we probably ought to think about
Yes.
some massive group training to get that done, because this is going to be a paperwork nightmare for staff. I don't envy Denise getting to file all of these forms.
And that's where I was going to go with, at League of Cities, we always take the training and, and if Tom's right and we have a different one, then golly, we're going to have to take,
Well, if we have a different one, we better make it right.
we better make ours right. I'd like ours to be what everybody else's is.
Exactly.
And I would just clarify for the record that, yes, AB 1234 is the training that the authority is subject to. So,
Right.
and it's a 2-hour requirement, and it's
No matter what.
correct.
So it's the same certificate that I have to have for my city is
Correct.
the same one I have to have here.
In fact,
Take a look.
I bring a copy of my certificate that I generally, League of Cities, I bring it, with a kind of copy here. But if we're talking about everybody else that's going to have to go through this training, oh my goodness. Plus, the 700 form's a piece of cake, but my goodness.
Well,
we're going to have to, this could really turn into,
Get it online. he did it online, and they probably questioned the time.
You know, for a brand new group that's never done it before, I think an in-person training is far more effective, and we could hold it here in the boardroom several different times. We could run through the online training, put it up on the screen, stop, have discussion, explain what it really means. I think a facilitated training the first time really makes a difference. I've found with new council members, they can do it online, but they don't get it. And it's not the same as having a facilitated discussion about what does this conflict, this ethical conflict, really mean? Is the box of chocolates the same as a $5,000 cash donation? You know, I mean, it's a discussion that needs to be had, and sometimes people don't get that distinction. So
Just to point, BBK did my first one. So, I mean, I know Mala can do it.
Yeah.
But the bigger thing is you can ask a poignant question and find out, oops, I'm not supposed to take plane trips or, you know, that
Yeah.
kind of stuff. And I know the county had a very good one when Sepulveda was doing it. And so there's enough available, but the being able to ask questions the first time is
really
worth its weight in gold.
absolutely, absolutely. Bob?
Yes, again, for clarification, you didn't come up with this idea yourself. So what I'm asking you, could you quote what brought this up again? I think you started out, we needed this, but there was questions about legal questions?
So every 2 years, there is a requirement that every agency in California essentially look at their conflict of interest codes and make a determination whether it needs to be updated at that point. I believe this process actually started sometime last year, where we started looking at the job descriptions for the commission and committee members, and at that point making a determination that it looked as if some of these commission and committees were essentially participating in governmental decisions. And at that point, we got more information from staff just to see how they historically operate. And it was pretty clear to us at that point that these recommendations are moving on to the authority board. They're not really being substantively changed at that point. And that is all part of the participation in a governmental decision. And that's one of the FPPC regulations that kind of lays out that process. And so once you start participating in governmental decisions as a committee or a commission member or even as an employee, at that point, that Form 700 compliance is triggered. And so we've been looking at this for probably a year now. This is the year, I think, at this point for the authority to kind of look at their code a little more closely and update it. And so we're at the point now where we think this is prudent.
Okay, I think I had a motion and a second, did I not? And it was Dave and Mike again. Okay, did you get that, Christina? All right, you probably had it before I remembered. Okay, very good. We have a motion and a second. All in favor, say aye. Aye. That passes unanimously. All righty, on to item 16, the I-80 San Pablo Dam Road Interchange Reconstruction. And this looks like Hisham.
Good morning, Madam Chair and committee members. The next three items under 16 are all related to the I-80 San Pablo Dam Road Interchange, Phase 1. This project is expected to be ready for construction advertisement in spring 2015. And the only remaining two items that we need to get checked off before we advertise are getting an easement from the West Contra Costa School District for the pedestrian overcrossing, which we now expect in December, as well as getting the Division of State Architect approval on the design plans because of the involvement of the school district. With that said, funding for the project, however, is not available until July 1st, 2015. And to expedite the schedule, staff is proposing that we request from the CTC what they call AB 3090 allocation, which allows us to basically use our own funds to advance the project and then get reimbursed starting in July 1st, 2015. Staff recommends approval of Resolution 1456B.
For that item.
Okay, for 16.1, correct? Yes. Okay, so Taylor moves, and you want a second for purposes of discussion? Okay. Hudson seconds for purposes of discussion. Mike?
Yeah, a question on the state architect. I've dealt with this before in Moraga. It's incredibly expensive when you get the state architect involved. And please confirm something. We are experiencing a 25% premium on construction cost. 25% of the construction cost if the state architect is involved. And I'm wondering, in this case, is that what's applying? And if it is a 25%, it's 25% of which cost? I mean, how much is it costing the state architect to be involved in what they're doing here?
I mean, the application fees alone are around $10,000 for their review time. However, because they're involved, the design standards we have to meet are the building code, which are different than what Caltrans uses for all of their other structures, which are bridges. These do require more foundation. They do require bigger structures. And I can tell you the increase in cost for the section on the school side is up by $500,000 because of their involvement. $500,000.
Well, that's $500,000 of additional bricks and
Cost.
mortar
Yes.
sort of thing. But what I'm getting at is I'm just looking at the fee.
10,000
The fee
Just
is-
10,000?
is around $10,000, yes.
for the application fee. Yeah.
It's a percentage of the cost of the structure within that they're reviewing, basically.
Okay, so it's a percentage of the section that they have jurisdiction over, not the entire structure.
And that's my understanding.
Got it.
And their
Thank
involvement,
goodness.
and their involvement is, apart from the fees, their involvement has cost an additional $500,000 in additional bricks and mortar.
Right.
Go figure.
Hey, got to pay for the state somehow. Okay, Tom? Did you have a question? You raised your hand? No. Okay. All right. We have a motion by Taylor, a second by Hudson. All in favor say aye. Aye. Opposed? Carries unanimously. Thank you. On to 16.2, Hisham.
And on 16.2, this item is just to request an extension of the termination date for contract 316 with URS. We want to extend it by a year until we go into construction. There is no change into the on the contract amount.
Okay, motion by Taylor, second by Metcalf. Any further discussion? All in favor? Aye. Opposed? That carries unanimously as well. Thank you. And on to 16.3.
And this item is just to authorize staff to request the remainder of the RM2 funds programmed for this project. It's about $583,000. We plan to use it to complete the design on this project.
I'll move Resolution 1453P.
Motion by Hudson, second by Metcalf. Any further discussion? If not, all in favor say aye. Aye. Opposed? That carries unanimously as well. Thank you. On to item 17, State Route 4 in Balfour Road, and I believe we have a handout on our desk. So this goes to Susan.
Yes. Good morning, committee members. And first, yes, I would like to note you do have a handout on this item. It's in regards to the attachments A and B on 17.1. There was some numerical errors which we corrected. I apologize for that. However, it does not affect the staff report nor any of the recommendations. So let me start with 17.1. These three items all relate to State Route 4 Balfour Road Interchange Project. 17.1 seeks authorization for a contract amendment with Quincy Engineering, who's preparing the plans, specs, and estimate, or PS&E package for the project. The State Route 4 Balfour Interchange Project has proven to be considerably more challenging and complicated than originally envisioned when we first started working on the design. Some of the complications include revisions to the approach in environmental documentation and additional permitting requirements, additional utility relocations that arose once details were developed on the bridge foundations, as well as more effort than initially anticipated to coordinate with PG&E and especially with Kinder Morgan. on design of their relocations that are required by the project. Additionally, the most substantial part is additional engineering efforts and complications required an additional 222 plan sheets for the PS&E package for a total of 600 plan sheets that were submitted with the 95% package. Additional detail on these changes is contained in the staff report and also in the letter attached from Quincy Engineering. It should, however, be noted that even with this proposed increase in their contract, the percent for the design work compared to the construction estimate is approximately 10.5%, which is below the normal for design services of this nature when working with Caltrans on a Caltrans approved project, and especially considering the complications that we've had with the utility companies. Speaking of the construction estimate, you may have noted in your staff report, and I would like to point out that the construction estimate's now at $42 million. And I'd like to highlight the fact that the project is currently facing a funding shortfall. So we do have a challenge there of approximately $7.5 to $10 million. So what is staff doing? Staff's looking at ways to reduce the construction cost. We're also looking very hard at the construction estimate itself. So it's very important that we keep the project on schedule so we can refine the cost estimate, the final construction cost, and also to proceed with these utility relocations that need to occur prior to going out to construction. So we really need to keep the utility companies on track and on schedule. So at this time, staff is requesting authorization for the chair to execute Amendment Number 2 to Agreement Number 354 with Quincy Engineering in the amount of $693,027. And we have Brent Lemon here. He's the lead project engineer with Quincy, and he'll be able to assist me in answering any questions you may have on this item.
Questions? Dave?
To me, this is just like what we were doing, pushing ahead with Highway 4, pushing ahead with Caldecott. I mean, you can answer all the questions you want. Let's get this thing done. This is the classic reason why we're talking about moving things up. I'm prepared to move the Amendment Number 2, and all the rest of the stuff I could read if I put my glasses on, but you know which one it is, 17-1.
Okay. We have a motion by Hudson, second by Taylor. Any further discussion?
If I could add to it, I mean, this is the classic, if you could move something up to get the funds to get it done. We're going to be doing the exact same thing when we talk about the Diamond Lane coming through here and they start getting shortages and stuff in Walnut Creek. These are the kind of projects people have been looking for, forgot about. We need to get it back on the front burner because Balfour can be an absolute disaster too until it's done. And I would prefer that it go right up to the front burner and get it done.
Thank you, Dave. Mike?
Yeah, I agree with Dave, but I'm going to ask a question here about, all right, we're going to see more of this kind of stuff where we need to really get it done. Because there's something about the way we do these things and the way we do the reconnaissance work to find out what kind of issues we're going to be coming up with, to try to uncover as many of these little bogeys as we can. Is there something that we're not doing maybe that we ought to be doing?
Well, I can respond, and then I don't know if Ross wants to jump in. In this particular instance, normally you'd go through a Caltrans process where you'd have a defined project report, and some of these things, utility conflicts and those things would be flushed out. In this particular instance, when the project came to us, that step had not been taken, and I think partly because we didn't anticipate we'd have funding for the project. So now we're going through the detail, and these things are coming to the front. So normally, when we do our homework up front, we would uncover, some of these instances. But really, until you go to a 35% estimate and you start really uncovering conflicts, that's where you really ascertain on phase 3 of 684 project we're discovering. Now we have 35%, and we have a much better handle on any conflicts out there in the physical aspects in the field and the updated construction cost estimate.
Yeah, this project was a series of 3 projects that we took over from the Bypass Authority. 164 interchange, and then Sand Creek and Balfour. And so we're taking it over, and so we had some design changes and things like this. And
We're
finding some of these
inheriting a
issues.
process. Okay.
I don't think I made my question clear then. You give me the reasons, and I understand all those. But what I'm asking is there something about the way when we get these situations, it's not uncommon. When we get these situations, there's something about the way we go about our work that could be changed. And this is really almost a rhetorical question. As a board member, I'm asking you have you considered that maybe there's something you ought to be doing differently? I don't know, maybe there isn't, but have you considered it?
And let me jump into that. I think what we're saying is that this is an uncommon situation. As Susan described, we normally have a project better defined and a better scope and cost estimate and schedule before we jump into fully funding it. So I think this one really was a product of using incomplete information when we added it into the strategic plan. So I don't think there's anything fundamentally broken. I think this was an opportunity that we took. We thought we were fine based on the information we had at the time. And now that we've gotten into the details, we've discovered the utility costs are much higher than they are. There's additional features with some of the traffic operation systems and so forth that were not considered that are now being required. So there are, to get to your direct question, there are some things we're doing more as mitigation measures than changes in how we're planning. And you'll hear about one of those in the next item where we're creating reserves to deal with this situation if it comes up. So I don't think there's anything wrong with how we're planning and prosecuting the work. But things do happen, and we need to be prepared, and that's where some mitigation strategies are being put in place.
When you have these situations where you just don't know, normally that's what contingencies are all about.
That's right.
So perhaps you should be thinking, when you have one of these situations where you know there are things out there, but you just don't know what they are, maybe it's time to look at your contingency level and say, well, do a higher contingency.
Yeah, we did not do that on this.
That way, you see, Bob won't get all cranky when you come at him with a change order. You know, he change.
It's on mine, okay.
Yeah, I think you're correct, Commissioner Metcalf. With the level of information we knew, we could have anticipated this and parked some contingency on this project, and we didn't do that. And we can look at that as we go forward. What you'll hear in the next item, I don't want to get ahead of ourselves, is that we are setting up some programmatic contingencies to address these things as they happen. Probably not of the magnitude that's happening on this project, but we do have a plan to ultimately fund the project once we have a good number. We just need to get there through this design process.
Okay. So we have a motion by Hudson, a second by Taylor. All in favor say aye. Aye. Opposed? That carries unanimously. Very good. On to 17.2.
I'll take 17.2 and 17.3 together. They're both requesting authorization for entering into agreements with PG&E for the utility relocations that I've just mentioned. These are standard PG&E relocations or agreements, so it's standard language for their agreements for these types of relocations. 17.2 is for electric distribution facilities. The estimated cost to the authority is approximately $1.17 million, and 17.3 is for 2 transmission towers. Estimated cost to the authority is about $1.52 million. So we're requesting authorization to enter into these agreements.
Dave.
Yeah, I'll move 410 and 411 if allowed.
All right. We have Hudson first, and was that Taylor second?
No.
That was, we want to make sure we get you on there. That's wonderful. Okay, so we have a motion by Hudson, a second by Butt. Any further discussion? All in favor say aye. Oh, we did have discussion.
I get where Mike's coming from. We were discussing it last night, too, on what can you do, and it's really, hindsight's just wonderful when you're looking at it. But the bottom line is, every once in a while, you got to find out you got one of these things, and you're going to lose more if you wait. And that's really what I looked in this whole thing. We can't put this on hold. So afterwards, if in fact you really want to take a look at it and discuss it more, that might be the better way to go.
Well, and as we go forward on other projects, we look at the process maybe. Okay, very good. Motion by Hudson, second by Bud. All in favor? Aye. Opposed? Carries unanimously. Thank you. On to item 18, which is an amendment to the 2013 strategic plan. Hisham.
Hi. This item proposes a couple of programming actions. This is, before I start, this is really the work of Randy and Ross, who have been able to come up with a plan to provide maximum leverage of our Measure J dollars. The first action is related to the Pittsburgh Center Station. This amendment will program $2.4 million from the State Highway 4 project reserve to build the station as part of the eBART project. BART will be contributing $3.6 million, Pittsburgh $3.5 million, and MTC $2.4 million to fully fund the station, for a total cost of $11.9 million. The second programming action is related to the eBART project. Because the lowest bid on the latest contract issued by BART came in about $9 million higher than the engineer estimate, BART had to tap into their project reserve to award that contract. And to replenish this reserve, MTC, BART, and CCTA staff are proposing to contribute $2.7 million each to the project for a total of $8.1 million. Staff recommends approval of Resolution 1455P, and I just want to say that this action is contingent upon concurrence by Transplan at their next meeting.
That's a stiff bill. Dave.
Let's see if I understand this. BART's bid, or a bid that came to BART, was $9 million over. So they're coming back for more money, of which they're only going to contribute a third or a fourth, or it's their bid. Was it their bid originally? I mean, they missed it by $9 million, or you know where I'm going with it. What the heck? And what were we just talking about on something that was an unforeseen overrun? I'm going to vote for it anyway because I think Pittsburgh, but I mean, I can't even spit it out.
How many more are coming? That's the question.
Well, I mean, maybe there's two questions there, and I'll try to get to both of them. So, yeah, this is a series of bids on the BART project. So this is the last major civil project, and it was a BART prepared bid and plans in the bid. So it did come over. I think this is maybe a half full answer. Is this is really the first time BART has contributed to the project. So prior to the project, it's been toll money and Measure J money and other dollars under either our or MTC's control. So I think that's what Hisham was alluding to, is that at least we've got BART to come to the table. We've got their attention that we want to be part of the decision-making process if we're being asked to foot the bill.
I think you answered it, but let me just stay with it a minute. BART tells you that they're going to need $9 million more.
Over 10%
Okay.
higher.
And they're going to contribute 2.7 towards it. And now you're telling me it's the first time that it just seems weird. I mean, they shouldn't be making their own bid, is I guess what it is. I mean, we want it. I know we want it, but I mean, really, it just sounds odd if you had to explain this to somebody.
Well, let me ask a question. This is to replenish the contingency, correct? This is to replenish the 10 million contingency. So if they don't need, we can keep our fingers crossed, the contingency, the money comes back to the donor?
That's correct. Yeah, so we're as
And
cost.
we have what control over the cost and whether they need the contingency? Any?
Yeah. So we're.
Okay, there we go.
But there's a philosophical issue here. When you put a construction estimate together, you put a contingency in there, you better expect to spend it, because what the contingency represents is the things you don't know about. But you just know that they're going to happen. And that's what contingency is. It's not a slush fund, which a lot of people think it is a slush fund. A lot of managers say, well, that's just a slush fund. It's not. You better count on spending it. So that 9 million is going to get spent. Assume it, and you won't be too far wrong. The question that Dave is raising is a good one. Why is BART only paying a third of this thing? I have another question. It says, how can BART be that wrong? In there, they had 86 million was their budget.
Mm-hmm.
Well, maybe we should have a discussion with them about how do they figure contingency? Coming in November. Way to go.
So
But that's, that's a pretty serious overrun, and that doesn't pass the red face test.
yeah, and I can't answer all that questions. I don't necessarily want to speak for Bart on that behalf. But in terms of control over this reserve, so it's a reserve that's for the whole corridor. It's not specific to any one project, and I don't know if that's a good thing or bad thing because it opens up for other uses. But we're in the process of establishing effectively what we've used on Caldecott for an executive steering committee. So it's me, Bob Power, who's over the capital program at BART, Dan McElhaney, who's number 2 at Caltrans, and MTC. So we're meeting periodically. We're meeting next Friday to talk about what BART's doing to mitigate this and some other issues they're having on the project. So we'll have constant communication, and this is just a programming action. There's another action required by this board before they can spend any money. So they'll have to come in and explain what's happened that would require them to tap into the reserve before they can spend it.
Okay, I'll just finish up by that. I'll let Bob go here. When this comes to the board, we're going to have an ex officio member there, Mr. Keller, who happens to be the president of BART board. I think he'd like to know that this sort of thing is going on. And, and it's his house.
Yeah, well, and I don't know if Joel will be here, but Grace Kruniken is actually scheduled to be here for a different reason in the November meeting. So we'll make sure that we have plenty of alert in advance so that they can have a good conversation for you. I thought I was turning it off.
Yeah, there's Grace. Through the chair?
Yes.
And Ross, didn't we, at the last meeting, okay, we're participants with those agencies, right? And we're contributing money. And didn't we ask, and I'm trying to remember now, didn't we say we wanted, don't we get to look at the contracts, or we wanted to talk to BART or something, didn't we? And that seemed to, huh? Yeah, you got chewed out for that. So I guess we'll really get chewed. I guess we'll really get chewed out if we ask them, how could you be off that much? So are we allowed to ask questions?
Yes,
As
we
you-
are.
Yes, we're allowed.
Yes, we are.
I don't want to, I don't know what I'm quite getting a mess we're into, but gosh, if we're contributing money and we're participants, shouldn't we have all the accessibility that everybody else has?
I think that's why Ross said that they're putting together this executive committee like we had on the Caldecott, so that all of the managers are having direct communication on a regular basis. It's not quite as good as having the contractors coordinating together, but it's probably the best we can get.
Well, informally, I had lunch with their contractor yesterday, so communications are happening. So Randy's going to get chewed out.
Yeah. Okay. All right, Dave.
I just want to focus on this one part. That part, I don't want to get into BART bashing, and I don't want to get into a thing, Joel, back and forth, and I understand where they're coming from, but I mean, BART is front and center in the news too, and I don't want to add to it. What I'm questioning is, if I were an outsider looking at this, and you tell me that BART put out the bid, and now they're saying it's 10% higher, they'll contribute, and they haven't contributed before, is what you said, and now they'll contribute 2.7. And I mean, if you're an outsider, you're looking at this as, well, they had to kick in 2.7, or they're looking at they just got 7. And they are the lead agency or whatever at this point, and now they're going to bring in CCTA on it, and people would expect us, I'm kind of thinking of who the people are in my mind, you all are too, that why didn't you ask the question of where's this overrun? And they're going to say, and you should know better because you're on other agencies that ask the same thing, whether it be regional or otherwise. And there's got to be a good answer for this. That's what I'm looking at, of how you do this and why you just contributed. I'm fine to do it because I want to see Pittsburgh get it. That's not what I'm questioning. What I'm questioning is, what the heck did we do? Kind of like where Mike was going, what did we do to get us in this thing?
Yeah, I think these are all good questions, good discussion. I think we could change the conversation a little bit too. It's a $500 million project. So if we focus on one contract, that's way over. But if you look at the whole project, the fact of the matter is this budget was reduced significantly back in 2008, or I can't remember when it was, or probably earlier. It originally was a $540 million project. When the bottom fell out of the market, they cut it back, and it's gone up a little bit. So it's kind of like where we were with Caldecott when it was experiencing some challenges. It's still under the original budget. So I don't think there's been a real poor job in managing the project. I think maybe a little optimism. So if you put it in that perspective, that the $10 million, which they haven't spent yet, really is still a small percent of the overall budget, and it's
Ross, put
less
it in
than what
that
they
perspective rather than the other perspective, which I heard. That's fine. That's the way I want to hear it and read it if it comes out. That makes sense.
I think for the full authority agenda, we need to add a paragraph in the beginning of the staff report that says, of the overall $500 million project for this quarter, and all of that, here's where we are relative to the whole quarter. This individual project has had an adjustment. So I think we need to frame this properly so that the public really gets the scope, because otherwise this one does seem like a huge aberration on its own. Okay? Okay. Not this one yet.
No, I did. I was 410 and 411. Are we on a new?
No, we're on item 18, 1455.
I don't believe you've had a motion yet.
No, we have not. Okay, Bob's going to move it. So Taylor moves.
I'll second.
Hudson seconds. Any further discussion? If not, all in favor? Aye. All opposed? And note for the record, that's a 4-0 vote because Commissioner Butt had to leave for another appointment. So we're on to item 19. Hisham, this is to actually give the money for Pittsburgh, I believe.
And staff recommends approval of Resolution 1452P, which appropriates the $2.4 million you just programmed as part of Amendment 2 to the station.
Okay. Motion by Taylor, second by Metcalf. Any further discussion? If not, all in favor say aye. Aye. Opposed? That carries unanimously 4-0. Very good. Next item of correspondence and news clippings, Commissioner and staff comments. I have no comments. Any from commissioners? All right. Executive staff? Nothing? Wow. Any other business?
What was the thing I told you last night? I forgot. You could at least tell them the email you sent out. I forgot what it was. You could at least make that one.
What, the email about the AA plus?
That's it.
We already talked about it.
Well, that's cheating.
Well, and congratulations to our executive director for becoming the chair of the National Freight Advisory Council. I think he happily accepted, and we are very honored to have him as the chair of that. We're talking about goods movement in our region. This is really good for us. So this is going to bring our recognition up. Mike.
Yeah, the election results, thank you for including this top sheet of this second handout here. I was wondering if you could, for the record here, could somebody like to comment on what we are observing here about transportation measures as they fared in the recent election. I'm looking at Lindsay because she looks like she has something to say.
I don't really have anything to say. I did include this just so you could get a general sense of how transportation-specific ballot measures fared in the election earlier this week. This was provided by Mark Watts, who isn't here today. So this is just for your information.
Commissioner, maybe I can add something to that. I was a speaker at the Asphalt Pavement Association's annual meeting, and I was on a panel that was moderated by Will Kempton, Janet Dawson, who is the chief consultant for the Assembly Transportation Committee, was on, and a lobbyist. And the questions were, what are we going to do about future funding for transportation? And Janet Dawson was very, very critical of the administration. Will Kempton has done a lot of polling statewide for gas tax increases and things like that. It polls very poorly in California. And so they asked me about how we operate at the Contra Costa Transportation Authority, and I said, well, promises are made, promises kept. So we're probably more in touch, and I mentioned the Tom Barnidge article about we're the inside-out version of Caltrans. We actually go out to the public, and we ask them what are their needs, what are their wants. We try to integrate that into our comprehensive transportation plan. We're changing the way we approach how we talk to the public, and we report out very transparently, hopefully as transparently as possible, the results. And so we're able to do things like this where you get 79% or 72% of the voters saying yes on an $8 billion future sales tax measure in Alameda County and San Francisco County. You get the local initiatives. El Cerrito passed theirs as well. And so they all started talking about this notion of promises made, promises kept. And Santa Clara was the first county, and Will was there at the time, and he does know about advertising, about making sure you deliver on your promises, and I think that's what we do here at the authority. And so they're talking about using us as a model statewide. And the state has a hard time because when you pump a gallon of gasoline into your car and you pay those 18 cents state and 18.4 cents federal, where's the money go? You don't know. Here, you know exactly where it goes, and it goes along the lines of what you had asked for, Commissioner Metcalf, is there more risk to be taken and bond more for future and get the projects done now? That's what we do. We actually have accelerated a 25-year program into 10 years, and we are working on your branding request on the fiscal cliff. So all these things are being worked out, and so I think this is kind of proof in the pudding that from a local perspective, we're more able to get the information and the projects in the hands of the voters faster.
Yeah, you just brought up an extremely good point. There should be a copy of this that comes to the full authority, and each one of us should be reporting to our councils, especially when we're televised, that the bare minimum, the first two lines that are on here, that this stuff is passed. You have a lot of people that think that, why are we paying for a bunch of empty buses running around, et cetera, et cetera? Well, you are not the majority of the people. When you get 74%, that's somebody speaking. And I mean, I'm surprised that this many went through. And I said on the transit too. I did not think, and what are we seeing in the polling about BART?
It's real high.
I think each one of us should be reporting this and get it front and center to people that transit is making its mark right now.
Well, to that point, and many of us are working on the CTP stuff, but I think the message, Lindsay, you mentioned to me in the other room before the meeting, that our outreach process is becoming a model, and you might want to just share that with the rest of the group.
Happy to brag about that. Imitation is the best form of flattery, and in the last few months, we've had several other agencies, including the Solano Transportation Authority and the Riverside County Transportation Commission, I believe, in Southern California, and BART, approach our agency because they've seen the process we've gone through for the countywide transportation plan update, and they want to model similar kind of visioning and public outreach processes on what we've done. So I've had several conversations with marketing and planning folks at all of those agencies about what our approach was, how we tried to include as many people as possible, and why we chose the tools that we did. And I think I'm still sifting through all of the comments. There's about 190 pages worth of comments from our process, so I'm trying to distill those down, and I will be back probably before this committee and the full board in December with a comprehensive report of what we heard. But to your point, we are trying to be very transparent, and we will be posting the raw comments from everybody who submitted a comment to us with all of their personal identifiable information stripped out, so that the public and you as board members can read these folks' own accounts and hear what they have to say in their own words, and use that to make some decisions going forward.
Awesome. Thanks, Lindsay. Any other comments? If not, thank you all. We are adjourned.